everyone, and welcome to Schwab's Mid-Year Market Outlook. I'm Marley Caden, and I'm thrilled to be here with you for what has become one of the most important conversations of the year for investors. For the first half of 2026, it's been interesting, to say the least. The S&P 500 lost 8% in the first 3 months of the year, with uncertainty regarding the conflict in the Middle East and the economic outlook here in the U.S. But the market has been resilient thanks to strong earnings growth and the continued AI build-out. The S&P has rallied more than 15% off the lows, and stocks are near all-time highs once again. Tonight, I'll be joined by Schwab's team of market experts to take a closer look at what to watch for next. Liz Ann Sonders will be here to break down the domestic economic outlook and what's in store for equities. Chris Ferrarone will weigh in on what to watch in global markets. Cooper Howard will cover what's in store for fixed income in the second half of 2026. Joe Mazzola will join me right here in Chicago to set up what traders can expect. And Jim Ferraioli will cover cryptocurrency. Then we'll wrap things up with a lightning round featuring our panel of experts answering your questions. Let's get things started with Liz Ann Sonders, Chief Investment Strategist at the Schwab Center for Financial Research. Now, at the start of the year, Wall Street was expecting roughly 16% earnings growth, Liz Ann. Today, we are closer to 25%. What structurally changed during Q1 reporting to cause such an unprecedented spike in forward estimates?
That story is brought to you by the letters A and I. That was the story. There was just a mass underestimation of how parabolic earnings has been. And there was also a decent amount of breadth in earnings. It wasn't just about AI. Most sectors saw an improvement. And I think analysts just had a heightened sense of caution, especially given that the third month of the quarter represented the first month of the war. And I think in that kind of environment, analysts were not inclined to raise the estimate bar. And then earnings season began. That clearly had to happen. You see the line that's gone parabolic, that was the first quarter, and that caused estimates for the remaining 3 quarters, as well as the full year calendar 26 numbers to go up. So this has been the most important underlying fundamental support for the bull market.
And I mean, that chart there is quite dramatic, that upside down hockey stick trajectory for the quarters in 2026 here. Is that rate of change sustainable for the second half, or do you feel that analysts may have overcorrected and we could be set up for disappointment here?
Well, I think that there is some risk of extrapolation and assuming that the pace of growth is going to persist. And that's one of the messages that we've been imparting, that in contrast to, say, the late 1990s, when the bubble was in the P, valuations were a bubble because there was no E in many of the leadership companies. In this case, you've got an extraordinary amount of E in the PE equation, and as a result, you've actually seen multiples come down. What I worry a little bit about is that the expectation bar has gotten so high that the margin of error changes a little bit relative to what we've seen in the past. And you might just get one-off troubles or maybe industry troubles as a result of some sort of miss, even if it's a marginal miss. So I do think that there is that potential for some volatility under the surface because that expectations bar is so high.
And where do concerns about inflation and rates come into play here? Do they threaten these elevated estimates?
So, the 10-year yield has the highest correlation in terms of equity market performance, and that has calmed down a bit. And I think that's been supportive of the market, too. The small cap rally, though, to some degree, which has been a strong rally. Oh, here actually, yeah, there's a chart showing the inverse correlation between the 10-year Treasury yield and the S&P 500. And you see that's in steep negative territory. And it's bounced around over this period of time. But I think this could be a secular change, representing a period where inflation volatility is a higher concern. And when you've got the 10-year yield keying off inflation more so than growth, that tends to be to the detriment of equities if inflation and the 10-year yield in turn are rising. So there are some benefits coming ahead of us in terms of the inflation trajectory by virtue of the base effects and obviously oil coming down. The problem is that the inflation story is a bit broader than just oil. In fact, AI is a component of the inflation story. So I don't think we're out of the woods yet. We may still have some upside. You still got some tariff pass through. So our base assumption is that the Fed is in a position to have to consider rate hikes this year.
And are the markets more sensitive to Treasury yields now than they were a year ago with the setup that we have?
Yeah, much more so. And again, it's been ebbing and flowing. That chart you showed before is only a few years. But I'm going to tease out a report that Kevin Gordon and I are going to write for the next publishing day, and I'll post it. And it's going to be a more secular look at the relationship between the bond market and the stock market, and in particular, bond yields relative to stock prices. We had the great moderation era that went on for about 25 years up until 2022 or so, and you had bond yields and stock prices moving in the same direction. The 30 years prior that was not the case. So we're going to take a longer term look at the data you're seeing here.
And if the Fed is in fact forced to move back to this explicit tightening bias, can these earnings continue to carry the heavy load for the S&P 500?
Yeah, there's not much sort of interest rate sensitivity specifically for where the trajectory of earnings has been concentrated in that broader AI space. Arguably, you do potentially run into problems as you go down into the smaller companies that have less earnings or maybe don't have earnings at all and struggle to pay interest payments. So I think we'll see some differentiating at the cap level to some degree, depending on what rates do. But the most important thing for the equity market is not simply just a move by the Fed toward tighter policy. It's the speed that they have to tighten policy that matters. If the Fed, once they move to a tighter stance, can take a slow escalator up and move slowly with rate hikes versus if they have to take a fast elevator up, the former is a much better backdrop for equities. What has happened in the past, though, in the lead-in to the first rate hike, cyclicals tend to do well. We're seeing that now. But once the Fed does start hiking, you tend to see a little bit more of a focus on defensive. So that's just another way to think about market dynamics as we approach the potential for a tighter Fed.
And when you mention AI, I want to have a conversation about CapEx because obviously this is a huge driver right now. I mean, as I'm looking at Amazon, Microsoft, Alphabet, and Meta, each growing their CapEx by about 70% year over year in 2025. As you look at that, Lizanne, are we seeing the markets basically giving these management teams a blank check for AI infrastructure? Or are you starting to see now that investor patience is beginning to wear thin?
I think there are starting to be concerns that creep in, and I think that helps to explain what I've been calling the great chip dip recently. And it's around a confluence of things, some of which is shown here. The amount of capital that is consumed from a capital spending standpoint is significantly higher than the profit contribution, as you see the share of net income, and this is relative to the S&P 500. So that gap is something to be mindful of. You also have increasing number of companies, just corporate enterprises, saying that they may have to start to consider paring back on some of the spend because we're not yet fully seeing the concrete nature of either productivity benefits or, in the case of those capital spending giants, the return on invested capital. So I don't think we're in anything resembling look out below, but those concerns are starting to creep in, and I think there's a more discerning eye on a lot of these data points.
And what's your thoughts on that narrative that we start to see some of this CapEx spending slow down if we don't soon see monetization backing it?
I think you will start to hear maybe more than just anecdotal stories of kind of weighing the pros and cons of a continued massive AI spend. Even with the price of tokens coming down, the spend is still significant. One interesting way to think about it, though, and I've had conversations with corporate leaders, is they're starting to say, at what point do we look at the cost of human capital as now being relatively inexpensive? So if we think about the concerns about the disruption to the labor force associated with AI, there may be some benefit there. And then when you look at how massive the margins are, certainly with what was reported yesterday by Micron, there's the benefit to the company, of course, when you have 75-80% margins, but somebody is eating the cost of that margin, and that is what's coming into the narrative a bit, and why I think analysts, particularly when you get into earnings season, are going to take a much closer look at that profit margin story, the productivity story, and the return on invested capital story.
And let's pivot here and talk about humans, particularly the consumer, and how all of this is affecting us. Because one of the things that really stuck out to me in your notes is that you pointed out that household equity ownership has reached more than 45%. That's nearly tripling from the lows that we saw during the financial crisis in 2008. So I have a twofold question here. One, does that make the market more vulnerable to corrections? And the second is, are households then systemically overexposed to an equity correction right now?
So this is a bit of a chicken and egg story. It kind of works both ways. So this rise in households' exposure to equities alongside what has been a very healthy bull market in equities since the bear market that we had in 2022 through the wealth effect has been a support for the economy. Where it potentially has the ability to sort of shift is if there is some sort of corrective phase in the equity market, more than just some of the dips that we've seen recently, does that feed its way into economic activity? And that's exactly what happened when you went from the late 90s into the early 2000s. You had the bear market begin in March of 2000. In 2001, we had an economic recession. I think that recession only came about because of the bear market in stocks. There were no major economic dislocations. There wasn't a financial system problem. It wasn't massively tighter monetary policy. It was the wealth effect once you went into a bear market. So I think we have to think of it as sort of, in multi directions, kind of that chicken and egg. It has been a tailwind. At this stage, I'd say base case is still as a tailwind, but it's something to consider. Does economic weakness, if that shows up first, work its way into a metric like that, or vice versa?
Lizanne, some great insight there. I'm looking forward to that next release from you and Kevin Gordon. I'll have my eyes out for that one, but we'll check back in with you in a little bit for our lightning round, but really appreciate it. That's Lizanne Saunders, Chief Investment Strategist for Schwab Center for Financial Research. Coming up, we've got Chris Ferrarone joining us to take a closer look at what we need to watch in the global markets. Will global earnings growth and expectation continue to move higher? That's all next on the Schwab Mid-Market Outlook.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The two grandchildren planning for their college educations. Someday it'll be their turn.
Intern, this place is incredible.
It's where I get all your office supplies.
Your golf balls,
Your fancy coffee, your giant TV.
it's everything in one place. It's like,
Schwab. Everything investors need, all in one place.
come again?
Yeah, at Schwab they can do everything. Invest, trade, get full service wealth management, and anything in between.
Think I'm gonna be sick.
We have to buy that now.
Schwab.
Invest your way with Schwab.
My parents didn't really talk about money at all. In college, everybody around me had money. I didn't want anybody to find out that I wasn't middle class. I was using credit cards to do anything and everything. I ended up with $20,000 of credit card debt. That's when I kind of realized, all right, I have a money problem. This is about how my finances got wrecked and how I fixed it. And if I could do that, you can do it too.
Welcome back to Schwab's Mid-Year Market Outlook. I'm Marley Caden. Let's get global. International stocks have experienced much of the same tech-driven growth to start 2026 that we've seen in the U.S. Although, instead of NVIDIA and Micron, international gains have been largely led by Korean memory stocks, Samsung and SK Hynix. For more, let's welcome in Chris Ferrarone, the head of equity research and strategy at the Schwab Center for Financial Research. Chris, great to have you here. Now, global growth appears to be accelerating across the board. What is driving that improvement?
Yeah, that improvement is a change from what we've seen over the last several years, where now we're seeing a real uptick in the strength of manufacturing. And that's not just CapEx related to AI, but we're seeing manufacturing growth really expand across most regions and most sectors.
And Chris, as we look at this shift from services-led growth to manufacturing-led growth, why is that important? Why are the global asset allocation implications of a manufacturing-led expansion versus a services-led one?
Yeah, it's a great question. I think there's a couple of key reasons why. First of all is when you look at the composition of global equity indices relative to the economy, they typically have a greater degree of manufacturing centric companies there, where the U.S., for example, has become a much more services-oriented economy. The financial markets, the global equity markets, have a lot of exposure to the manufacturing sector. So it's things like energy, industrials, of course, on the tech side, given the AI CapEx cycle. We're at basic materials. You can go down the list and see the strength of manufacturing showing up in corporate earnings.
And how much of this manufacturing resurgence is tied directly to AI infrastructure spending?
Well, certainly it's a great deal of it. And we've seen that in the surge in earnings in the semi space, as you noted. Semiconductor stocks in emerging markets in the United States are seeing triple-digit earnings growth this year because of the shortage driven by AI spending. But it goes beyond that. We're seeing strong earnings growth really across the board that in those sectors that are exposed, and that really goes down to classic manufacturing sectors like industrials, to the energy and raw material providers in the basic materials sector. In the telco sector, obviously utilities are tied to AI as well, given the build out of the CapEx, the AI data centers. So we're really seeing that strength quite broad, but the concentration in earnings, the real strong earnings growth numbers that we're seeing are definitely tied to that AI CapEx cycle.
And Chris, that chart we have on the screen there says that earnings expectations have boomed. Which regions have the strongest outlook right now?
Yeah, well, that earnings boom is one that it's not just in expectations, it's in realized earnings as well. On a trailing 12-month or 24-month look-back period, we've seen some of the strongest earnings growth, especially out of in mid-cycle type dynamics that we've seen in a long time. On top of that are really strong expectations related to AI CapEx spend.
And why have these emerging markets benefited so significantly from this AI boom? And I guess my secondary question is the international equity performance now becoming increasingly dependent on AI-related demand?
Yeah, so I think there's a couple of things to note here. One is that, the capital spending by the hyperscalers who are investing in the data centers and looking to build out AI are causing a shortage in semiconductors, and that shortage is driving prices of semiconductors to cyclical highs, and that is driving the earnings of those sectors. But in the chart that you showed before, the significant contribution to earnings growth, expected earnings growth, is coming from the tech sector and just a handful of those semiconductor names. But you'd also note that most of those other bars on that chart are positive, meaning that there is breadth in terms of earnings growth. It's just the scale of what we're seeing in terms of the growth in that semi side is outweighing pretty much everything else. And when we think about concentration in global equity markets, there's a couple of ways to think about it. First is just in terms of, the absolute size of certain sectors now relative to the broader market. So if you look at the S&P 500, for example, or emerging markets, you've got, 50% of those indices now comprised of tech, communication services sectors, which is much larger than it's been historically. And then on top of that, you've got the earnings concentration. That concentration that's really driving earnings growth here is coming from those same sectors.
And we talked a lot about growth, but I want to talk about this divergence we're seeing between the growth and consumer sentiment, because as we look at global manufacturing PMIs, they're expanding. But as we look at global consumer sentiment, it is noticeably deteriorating. So how long can this manufacturing boom persist while the end customer is feeling economically pinched?
Yeah, I think there's, there are certainly limitations to how long this capital investment cycle can persist. We're seeing hundreds of billions of dollars being spent from just a handful of hyperscalers, and consumer sentiment has been weak for a while, and obviously hasn't impacted earnings growth too much. But that's a combination of those factors. One is real incomes have stagnated, although the labor market is fairly stable at the moment. If you look at inflation-adjusted incomes, it started to dip into negative territory. That's because of the rise in input prices and inflation. When you survey consumers on the price of food, on the price of gasoline, on the price of housing, certainly it's a pressure point.
And Chris, you mentioned the hyperscalers there, and you brought up a really interesting data point here that the capex from just the big five, Oracle, Meta, Microsoft, Alphabet, and Amazon, is approaching 2.5% of the U.S. GDP. If they decide to rationalize or slow down their investment spend in late 2026, what does that do to the global manufacturing expansion that you're tracking right now?
Yeah, it would certainly dampen it, no question. I think what we're fairly comfortable now saying that spend is not looking like it's just going to be faded anytime soon. And in fact, if we look forward to 2027, there's planned increases to that capital spending. That's not to say that it's not a risk to markets. It clearly is, given the enhanced expectations. But we don't foresee any near-term pulling out of the rug, if you will, related to this cycle.
Chris, a pleasure talking to you. I'm going to check back in with you a little bit later in the show. We have some viewer questions for you, so stay with us. But that's Chris Ferraro, the head of equity research and strategy at the Schwab Center for Financial Research. Coming up, we are going to dive into fixed income with Cooper Howard. Where can bond investors find opportunities with yields being off recent highs? We'll have that and more when Schwab's Mid-Year Outlook continues after this short break.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Hey, Pop.
Hey, Andrew.
Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim's my financial consultant. I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Schwab's Mid-Year Market Outlook. I'm Marley Caden. We've covered equities. Now let's take a closer look at fixed income. Joining us now, Cooper Howard, Director of Fixed Income Research and Strategy at the Schwab Center for Financial Research. Cooper, great to talk to you. The fixed income market is experiencing elevated volatility. We saw a flattening yield curve following this hawkish pivot under our new Fed Chair, Kevin Warsh. Yields are down off their recent highs, but you say there are still excellent opportunities that remain across the landscape in fixed income. Where exactly on the curve are you finding the most compelling risk-adjusted entry points right now?
Well, thanks for having me on this evening, Marley. Yes, there definitely are opportunities within the fixed income op space. And I think if you look at duration positioning right now, like you'd mentioned, the Fed is another big one that's going to have an impact to the fixed income market over the second half of the year, in our opinion. And as Lizanne kind of discussed, the bias right now in terms of the market is that there is likely going to be a hike. Now, we're not exactly there yet. We do think that there is a little bit of a wait and see mode from the Fed. So we would not be surprised if the Fed remains on hold for the remainder of the year. But what that means for the outlook for yield and where investors should be positioned is we right now have a little bit shorter of a benchmark duration. So what that means is that if the average investor, say, has a 6-year benchmark duration, and that's kind of a good benchmark. It just looks at like the Bloomberg US Aggregate Bond Index duration, which tends to be a proxy for a lot of fixed income investors. Right now, a duration of about 4 to 5 years we think can be appropriate. And the reason for that, Marley, is what we do see a little bit of limited upside in longer term yields going forward. Yes, yields are a little bit off their highs, but I could make the case going forward we could see potentially higher yields over the rest of the year. Now, we're not expecting a blowout in yields, but I do think that it would not be surprising if they drift a little bit modestly lower. Also, with the Fed likely to be on hold, maybe with a bias towards hiking rates, I do think that that's less of a penalty for being a little bit shorter term. So being shorter term, we're not saying going all the way to cash, because we do still see opportunities with intermediate and longer term bonds, but we would do so in moderation.
All right, a lot to unpack there. So let's start with the last thing you said. You said the penalty for being too short right now is a little bit lower. So as we look at that, why would a conservative investor lock in a longer duration bond when cash and T-bills are offering highly competitive, low risk yields right now?
Yeah, this was one of my favorite questions. And it was really a big question that we got as strategists, especially when the yield curve was inverted, because you were seeing higher yields on shorter term investments rather than longer term investments. And the way we like to say it is that it's reinvestment risk. And basically what that means is that by buying a longer term bond, you're locking in that yield and you're not at the whims of the Federal Reserve. So if you were to plot the yield for very short term investments relative to that of the federal funds rate, they very closely track one another. That's none like the 10-year Treasury, where it moves a little bit differently. So we would expect that we don't think that it makes sense to put your income stream, if you're investing in fixed income for that income stream, at the whims of the Federal Reserve. So yes, we do think that there's probably a bias towards hiking rates, but let's assume that everything starts to look okay, the resolution with Iran becomes much more concrete, and they move back into a cutting bias over the rest of the year. I think that's a high bar, but it's a possibility that that could happen. You would see yields on short-term investments move lower. So we do think that it does make sense to lock in some longer term bonds, lock in that attractive income and across the yield curve right now, and not be at the whims of what the Fed is going to do with the income, with your income stream.
And oil prices have become a major driver of rate expectations as well right now. Why has the fixed income market become so hypersensitive to that compared to other economic indicators?
You know, it's inflation. And it's the story of inflation. That's been the story with the fixed income markets since the onset of the Iranian crisis. And Lizanne hit the nail on the head when she discussed that the correlation between the 10-year Treasury and oil prices has been very closely related to one another. And it's because of those inflationary concerns. Because as we see higher oil prices, that doesn't just mean higher prices at the pump. It also means higher shipping costs, higher fertilizer costs, higher packaging costs. And the concern to many fixed income investors and the way the fixed income market is reacting right now is that those inflationary issues are going to become embedded, and you'll see higher longer term inflation, and therefore that's why yields are moving higher over the first half of the year. Yes, we have seen a little bit of a pullback just recently, but not nearly as much as in terms of what's happened with the price of oil overall. And it's because there's underlying concerns that inflation may be embedded going forward.
So, Cooper, if we see sticky inflation keep the front end of the curve pinned down, then what does your modeling suggest might be the ultimate floor for the 10-year Treasury yield for the second half of 26?
Yeah, so I would not be surprised, Marley, over the next half of the year if the 10-year Treasury trades in a range of about 4 to 4.5%. Now, we are very closely within that range. We've been in that range for quite a while. But I do think that if I were to say, well, where could we break out between that 4 or 4.5%, I say there's more of a likelihood that we break out to the upside. Part of the reason why is that if we break the 10-year Treasury down into its major components, the Fed funds rate, inflation expectations, and then the term premium, I do believe that there's more upside to all three of those than there is relatively downside. Like we'd mentioned before, we are seeing sticky inflation, so that's going to be a concern for longer term yields. Also, that term premium, that's that uncertainty for rolling over shorter term bonds and the uncertainty related to the Fed, that's likely to move a little bit higher, at least not move anytime lower anytime soon. So I do think that those are all factors that will keep longer term yields relatively elevated. But again, we're not calling for a breakout to the upside. I think things are likely to be range bound going forward. But if you were to say, will they go higher or lower? Probably higher would be my base case.
All right, so with that setup you mentioned there, we've got the higher for longer, potential for a hike from the Fed here. You are recommending a portfolio structure split between core and aggressive, capping your aggressive allocation at 20%. What specific asset classes qualify as aggressive in this current macroeconomic climate?
Yeah, so I think if you look at the aggressive income sleeve, you're going to be looking at things like preferred securities, high yield bonds, emerging market debt. And right now, we're not saying avoid aggressive income. We just think that it makes sense to be a little bit cautious there. And within that aggressive sleeve, we would look at things like preferreds, high yield corporate bonds. And part of the reason for that is that we do think that the absolute yields that they're offering are relatively attractive. I'd be remiss if I didn't mention that spreads are relatively tight, but we do think that the absolute yield that they're offering can make up for that tightness in spreads. If you also look at the relative fundamentals of corporations, especially banks, which many preferreds are issued by, they're in pretty good shape right now. So we're not seeing major concerns in terms of a credit issue in that space. One thing, though, to be aware of is that preferreds usually have longer term durations, so they're a little bit more sensitive to rising interest rates. So that's something to be aware of and cognizant of going forward, Marley.
Cooper, always such a pleasure to talk to you. It's been too long, but glad to have you here tonight. And we'll have more questions for you coming up from viewers a little bit later in the show. That's Cooper Howard, Director of Fixed Income Research and Strategy at the Schwab Center for Financial Research. Coming up, we're going to dive into what traders should be watching for the rest of the year with Joe Mazzola, and Jim Ferraioli will join us to examine Bitcoin and how the current crypto bear market is impacting different crypto asset classes. We'll be right back on the Schwab Mid-Year Market Outlook.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide. no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome back to Schwab's Mid-Year Market Outlook. Let's talk trading. Joining me now in our Schwab Network studio is Joe Mazzola, the head of trading and derivative strategy at Charles Schwab. Now, Joe, let's start by focusing on the markets in the near term. You pointed out that the post-FOMC recovery here in U.S. stocks remains remarkably narrow. Does this suggest that the markets have not fully digested the latest Fed shock and the new regime that we're dealing with? And what specific technical indicators are telling you that this recovery could be built on a somewhat fragile foundation?
So what's interesting is I think maybe up until the last couple days, that had been a theme, right? It had been very much semiconductor driven, and we'll show some charts in a moment that kind of shows, that performance, 85% up this year in terms of the semiconductor index. We have seen a little bit of broadening though, and I think today was an important day because you had GDP come out beating estimates. You had PCE, which is the Fed's preferred inflation gauge, and that came in a little, basically in line, still at 4%. But for the most part, I think because it came in line and didn't exceed, markets took that as a good sign. And you had some personal income and personal spending data that came in a little bit higher as well. So, overall, and then you pair that with jobless claims that basically came in line, the economy's in good shape. So I think that led to a little bit of broadening today. But whether or not that continues going forward, I think it's going to be hard to tell. I think what you need to do is you need to continue to see rates come down. If rates do come down, you'll probably see more of a cyclical trade going forward, which would benefit things like financials, benefit things like industrials. Some of those sectors, just the last couple of days, Molly, they've really started to pick up quite a bit as the data has shown that the U.S. economy is in a pretty good place.
Yeah, I have this conversation with Alex Coffey nearly every day on Market on Close. We take a look at how the broader market is performing against the big names, but the semis are still dramatically outperforming the broader market. I mean, what is driving this move that seems unstoppable?
Earnings, and more earnings, and then let's add Micron earnings on top of that as well too. I mean, blockbuster numbers, just crushed it. I think heading into that earnings print last night, there was a bit of fear. I mean, we saw the 13% sell-off heading into the close on Tuesday or on Wednesday, excuse me, and then we get that just a blowout number, and it felt like the market just took a collective sigh, right? And then here's what happened. We open up and everything's up, and then we started to roll back. And why did we roll back? And I think this chart it tells quite a bit here. A 90% move from year to date in the semiconductor index, but the Mag 7's not participating, and that has been the structural driver of the market for 3-4 years now. It's all anyone ever talked about, and I think there's a couple things that are at play here. For the longest time, the Mag 7 was really the trade of choice because of a few things. They had wonderful balance sheets. They were very cash rich, generating cash and cash flow at a really high clip. Well, now we're seeing different types of financing. We're seeing them not only issue shares, we're seeing them go to the debt market, and we're seeing them use a lot of that free cash flow as a way to add about $750 billion in terms of spend towards AI. And who is that benefiting? It's clearly benefiting the semiconductors. So
has the semiconductor trade become the market then? Because I watched the anticipation into Micron. I actually still, funny, have my Post-it note with their earnings behavior and historical earnings. There was so much fear tied to it. They beat on earnings and guidance the last 8 quarters, but only 2 of those times did we see a positive market reaction. So is this now the trade?
One of the things that really stood out to me from that earnings number was the gross margins. 85%. I mean, that's unheard of. And I think one of the differences here, and we got another chart up here that's showing semiconductors as a percentage of the S&P 500, it's moved, and as you mentioned, it's moved in the direction where it's become a really important piece. but I don't think it's in that territory where we need to start worrying about it like we did when we were looking at hardware components back in the early 2000s and late 1990s. I think we still have some room to go before we get there. But I think one of the big differences that we're seeing right now, and you and Liz Ann touched on this in the first segment, is this is not an expansion in terms of multiple. It's an expansion in terms of earnings. So it actually compresses multiples. So the real fear is that earnings will curtail at some point, roll over, and that's when you might see a pullback. At some point it will happen because it always happens. But from the data we heard, last night heading into today, Micron's not expecting that to happen in 27, 28, and we'll see kind of how the markets respond to that.
Yeah, I think the market really responded to that and beyond comment
yes,
when we were looking for some visibility there. I'm glad you brought up the semis versus the hardwares because you have a really interesting chart that compares the semiconductor weighting versus tech hardware weightings in the late 90s and the early 2000s. We keep having this conversation about .com and bubbles. Why does today's 19% versus the 26% spread signal less extremism compared to the .com peaks?
And like I think it goes back to the earnings versus what were projected earnings in the late 90s, early 2000s. I just think the roadmap that we've seen or that these companies have laid out for us portends that these earnings are going to continue to go up. Now, that can change, right? As we know, one of the things that I look at quite a bit, and I think a lot of traders look at when they're analyzing companies, is something like a PEG ratio, right? So you've got the PE, which most people understand is price divided by earnings, but then you add the G underneath it, and that's the expected growth, and that is the subjective component of the PEG ratio. So you're looking at companies, whether it's whether it's something in the semiconductor space, the memory chip makers. They are looking at PEG ratios under 1, and those basically what that means is you're paying less than $1 for $1 worth of growth in terms of the earnings over the next couple years. So they're trading at a discount, and I think that the markets are rewarding them because of the fact that they've generated such a positive earnings flow.
And we saw semiconductor volatility increase substantially coming in to Micron. But my question is now, is the AI trade reasserting itself? Did Micron do enough to assuage some of the concerns surrounding the trade, and particularly surrounding visibility going forward?
So I'm going to answer this one from a trader perspective, because when you look at a volatility chart like this, I look at that and I say that's opportunity, right? There's opportunity, especially for people who are long companies or long the stocks from a very low cost basis. I get this question all the time. I was at an event here in Chicago last night, and this was one of the top questions that you get. We have a lot of concentration risk, not only in the market, but in people's portfolios. And how do they take advantage of this volatility? Well, when you see type of volatility like this, a lot of times what happens is the calls are really expensive too. So things like collars, things like call spreads are ways for investors and traders to maybe reduce some of that risk and use those as a way to kind of optimize some hedging strategies within their portfolios.
Joe, really appreciate you highlighting semis with us and those all-important earnings that we got from Micron yesterday. We're going to leave it there, but stay here with me. I'm going to talk to Jim for a moment, and then we've got more questions for you. That's Joe Mazzola, head of trading and derivatives strategy at Charles Schwab. Let's move now to crypto. Joining us to take a closer look, Jim Ferraioli, the head of crypto research and strategy at Schwab Center for Financial Research. Jim, great to have you on. Now, we saw Bitcoin hit the lowest levels it's seen since October of 24 during the past two trading sessions. What is driving this weakness to levels below $60,000?
Yeah, look, this is a classic bear market. Bitcoin entered its latest bear market in October. It's continued to trade in a bear market. This is a type of event that takes some time to recover. Most recently, some of the macro data has been putting pressure on Bitcoin. Obviously, the PCE data that came out today and the stronger GDP numbers, that's pushing the dollar higher, that's pushing real rates higher. Those can be negative in the short term to Bitcoin. These are, cryptocurrencies are long duration assets. They're non-dollar assets. And so in the short term, that's what's been impacting it. What ultimately caused the bear market, we had a buildup in leverage in the futures and derivatives and options space, and we had a mismatch in the spot markets. Many people had actually stopped buying, and so you kind of had this mismatch. You had a shock tariff announcement coming October 10th, and here we are now down about 50%. And so again, sentiment's washed out. There's a lot of other areas to chase momentum in the markets right now. Joe was just talking about with semiconductors and all things AI. And so that's kind of the state of affairs in crypto at the moment.
And the $60,000 level is very important in some of the data that you sent over. You highlight it as the current cost of production for efficient miners being in the low 60,000s. Now, why should an investor view that specific production cost as a hard fundamental floor for Bitcoin?
So when we think about the cost of producing a Bitcoin, there's really two core inputs. You have fixed costs, which are your semiconductor fleet, and you have variable costs, which is the energy to produce the Bitcoin. And so as you can see, the miners that have the either cheapest energy inputs or the most efficient fleets, they typically over time have lower production costs. And so what we look at, and we normalize this over a cycle because these production costs can vary based on Bitcoin's prices, but you can see that in general, the efficient miners, those with the best equipment and the cheapest energy costs, they produce Bitcoin at around $60,000 per Bitcoin. So we think of this as a key level of fundamental support for Bitcoin. Coincidentally, the 200-week moving average is right around $60,000 today too. It's about $62,000. And so similar to other growth assets, this can also serve as a long-term level of support. So these are two levels we've been closely watching all year. We first got down to these levels in early February. We bounced. We had a little rally later into the spring, and we're retesting them again. But again, at these levels, we think there's both firm fundamental support and there's also strong technical support.
And on the flip side of this, you highlight that the inefficient miners actually have a production cost that sits closer to $95,000. I mean, we're significantly off of that. If Bitcoin can't break sustainably above that level, then what happens to the network's total hash rate as these inefficient operations would eventually get squeezed out?
It's a good question. Seems like you've been doing some of your Bitcoin homework. As prices fall down below miner production prices, miners will temporarily shut down. And we've seen that. There's an internal mechanism on the Bitcoin blockchain that ensures a block is mined roughly every 10 minutes. As more miners are on the network, it becomes more difficult to produce that latest block. As miners temporarily shut down, it becomes easier to produce the latest block. And so we've actually seen mining difficulty fall about 20% since its October peak. And so that tells you miners are leaving the network because it's not profitable for them to leave at these levels. And so one of the things that we actually look for when we think we may have found a local bottom or an ultimate trough in a sell-off or a bear market is when these miners start to rejoin the network. That's often confirmation that they're signaling that it's productive now at the current prices for them to mine again. And so again, that's what we're looking for. And current estimates, the next difficulty adjustment will be one higher. And so again, that would be supportive of the view that that fundamental level of $60,000 is holding.
And Jim, I've been waiting to talk to you all week just to get your thoughts on what's actually driving these moves in crypto that we're seeing. Do you view it as being fundamental or do you view it as being psychological?
Oh, it's a little bit of both. I mean, the entire crypto market is certainly down on itself. The fundamental aspect is investors are reacting to the higher dollar and higher real rates. And so as I mentioned before, those things can impact Bitcoin in the short term. And it's definitely psychological. Crypto investors are typically momentum chasers. They're down on themselves. If you bought Bitcoin in the past couple of years, you quickly saw a rally up to $126,000, and then you saw your position get cut in half. And so it can take time to kind of rebuild momentum after something like that. And to put that into context, we have a couple measures of what the average investor's cost basis is, and it's about $80,000 today. So the average person bought Bitcoin at around $80,000. They had a nice rally up to $126,000, and they lost half their investment. And so they're feeling down on themselves. They're not necessarily abandoning the asset class, but that was the level we reached a bit earlier this year after rallying off the lows where we started seeing selling. And that makes sense. People have now recouped their initial investment. They might sell and revisit it later. And so it's a bit psychological. Maybe people are down on the market. It's a bit fundamental. There are macro drivers that are working against Bitcoin at the moment. And ultimately, we're in a bear market, and these things take time to resolve.
Jim, really appreciate you being with us tonight to take a closer look at crypto and at Bitcoin there. Jim Ferrioli, the head of crypto research and strategy at Schwab Center for Financial Research. Stay with us. Coming up, it's time for our lightning round. Our Schwab panel of experts weighs in on a variety of topics when Schwab's mid-year market outlook returns.
She looks like you, Dad.
Aw, she's got your smile.
Carl.
Yep, your #1 broker's here to welcome your new little dependent.
Actually, we invest with Schwab now. They have everything we need all in one place.
I can set up her college fund.
I've been learning about new trading strategies.
And Schwab helps me generate retirement income.
All this Schwab is everything you need is making me cranky.
Does somebody need a nap?
Schwab!
Invest your way with Schwab.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Intern, this place is incredible.
It's where I get all your office supplies.
Your golf balls,
Your fancy coffee, your giant TV.
it's everything in one place. It's like
Schwab. Everything investors need, all in one place.
Come again?
Yeah, at Schwab they can do everything. Invest, trade, get full service wealth management, and anything in between.
Think I'm gonna be sick.
We have to buy that now.
Schwab.
Invest your way with Schwab.
Welcome back to Schwab's Mid-Year Market Outlook. It's time for our lightning round. We asked for viewer questions and you all came through, so thank you. Joining us once again, Liz Ann Saunders, Joe Mazzola, Cooper Howard, and Chris Ferrarone. Liz Ann, let's start with you. One viewer wants to know, what's your inflation outlook and how is the stock market interpreting the recent comments from the new Fed chair?
Downside to inflation, certainly headline inflation by virtue of the move down in oil prices, but there are still some feeders that could mean continued stickiness in core measures of inflation. Core services ex housing is still relatively hot. So I think that puts the Fed in a position to think about tightening policy. I think everybody's in a wait and see mode as it relates to Kevin Warsh. The creation of these task forces is what I think there'll be a lot of focus on to try to see what comes out of those as it relates to the communication strategy, what will happen to the dots plot, will he continue to hold press conferences, is he considering alternative measures of inflation, et cetera.
And Cooper, let's come to you and stay with the Fed here. How will the changing of the guard at the Fed impact the bond market?
You know, I think that Liz Ann hit the nail on the head in wait and see mode. So I think that right now we have to see ultimately what comes of the task forces. It would be likely that we'll see a pullback in terms of communications from the Fed. And I think what that will probably mean to rates is a little bit more volatility on the short end of the yield curve. But I don't think that this is anything new to the fixed income market. If we think about a press conference after every meeting, that was something that Powell put into place. If we think about the SEP and the dots plot, that was a Bernanke invention. So we would go back to an environment where we would be pre those communications. And I think that the market would just be able to hum along and do all right with that. But a little bit more volatility probably, Marley.
And Chris, this next one is for you. What are the potential long-term effects of the Middle East conflict on global markets?
Yeah, Marley, you know, that's a challenging one here. You know, that the Middle East conflict was not just about an energy shock. It was, you know, yet another episode of supply chain pressure, another episode of inflation, another episode you know, of geopolitical stress, and over the long term, you know, that will add a risk premium to markets. That will add demand for energy security, domestic energy security. That will add, you know, an impact for countries to look for and companies to look for supply chain reconfiguration. So there are a lot of long-term implications of this conflict with Iran, even if the Strait opens up in the near term.
All right, and Joe, coming to you here, SanDisk was the top performer on the day, so we have a memory question here. Is there any risk of demand destruction in memory chips because of the rapid increase that we've seen in prices, and what warning signs should people be looking for?
Oh, yeah. I mean, I think at some point there is. From what we've heard, at least in the Micron earnings yesterday, it doesn't seem to be the case in 2026 or 2027, but, that can change very rapidly. I think what I would be looking for, maybe from a technical standpoint, is something that hopefully Chartis will be looking at, and that's the 21-day exponential moving average. It's been a really good indicator for the semiconductor index, which is what we were talking a little bit earlier about. Every time it's kind of pulled back, it's bounced off that, and I think if we see renewed pressure, we're on a pullback of that would be at least an indication that things will maybe chopping around a little bit more volatility going ahead.
And Lizanne, another viewer wants to know, do I need to be concerned with the national debt? Don't major crises start with over-leveraging?
Well, I think we have to be concerned about it because of the crowding out effect and the fact that the cost of servicing the debt now exceeds the cost of defending our country in terms of defense spending. But we aren't concerned about something calamitous. So when I get those questions, and I do all the time, there's often a follow-on to it. Will the dollar lose its reserve currency status? The answer to that is no. There's no replacement for it. Will the U.S. default on its debt? We will not default on our debt. Will foreign creditors just wake up and start dumping treasuries? They will not do that. Diversification is happening, but there's still ample demand for treasuries. So the crowding out effect, the compression that it puts on economic growth is valid, but those sort of Armageddon scenarios, we don't put a high probability on.
And Joe, this next one is a question I ask myself almost every single day. Why is there so much more volatility in stock prices, even on days with little news? I mean, the first half hour of trading this morning, a perfect example here.
It's dispersion. And I think I would look at the volatility for single stocks relative to the indexes, because for the most part, index volatility has been pretty well contained. You get a couple days above 20, but for the most part, the VIX gets back below that. It's the single stock volatility that's been really interesting. And I think that has a lot to do with just the expansion in terms of options trading and maybe some of the levered options trades that go along with that, whether it's the ETFs or just kind of the single stocks themselves.
And Cooper, we've got another one for you. A viewer wants to know, are munis a good way to protect income that you've gained through individual stocks?
I think that if you're an investor who is in a high tax bracket, and especially one who's in a high tax state, then munis are worth a second look. If you look at just the absolute yield right now and adjust it for being in that top tax bracket, that's north of 6.5%, 7%, depending on the state tax rate you include. Also, if you look at the volatility related to munis, it tends to be very, very low, especially related to the equity market. So it can be a diversifier from more volatile equities. So I do think that if you are an investor who is in that higher tax bracket and you are in a taxable account, then yes, munis are worth a second look.
And Chris, coming to you now, how would you allocate your investment between domestic and international investments, and what macro events are you keying on?
Yeah, we talked before about the high concentration in global equity markets, and that high concentration really leads us to want to add diversification to global equity portfolios. So that for us means maintaining an exposure to global equities. It's not a time you want to put all your eggs in one basket, whether that's the U.S. equity market, whether that's semiconductors, for example. And so, we think that, maintaining that international exposure is important here, and look for additional sources of diversification where you can. It can be from, owning high quality companies. It can be dividend strategies, which can not only diversify an equity portfolio, but can add some income while you wait. There's a host of things that fall into that equity diversification bucket. But certainly on the international side, when we're thinking about U.S. versus international, it's maintaining that broad exposure. And in terms of the second part of that question about the macro issues that we're looking for, look, this market is right now, there's really two big things that are the focus. First is inflation, and there's a lot of moving parts as we've discussed here. And the second obviously is around the AI CapEx cycle, and both of those again are things that lead us to want more diversification in our global equity portfolios.
Really appreciate you all taking the time to be with us tonight. That is going to do it for our mid-year market outlook. Thank you to our entire Schwab team for their contributions and insights. I'm Marley Caden. Thank you all for watching.